So let us try to go through that. Yeah, that statement for cash flows. We try to go through it and we see whether we can manage to complete. See whether we can manage to complete. Yes, we see whether it's called what? Carico group. Carico group. So we have so we arrange the cash flows. We have cash flows from operating activities. Cash flows from operating activities. Actually, we also have cash flows from where? Cash flows from investing activities. Cash flows from investing activities. And also we have cash flows from financing activities. Cash flows from financing activities. So from that information now, we have to use the indirect method. We have to use the indirect method. We have to use the indirect method. Use the indirect method. Use the indirect method of presenting cash flows from operating activities. We have to use the indirect method of presenting cash flows from operating activities. So we go to the income statement. We go to the income statement. So we have, we go to the income statement. We start from where we have profit before taxation. Profit before taxation. And we can see it from our income statement. And the profit before tax is equal to what? We have profit before tax. Profit before taxation, which is given as 3,200, is it? And from that point, that's what we put there. From that point now, we move upward and make an adjustment to that, is it? For example, items that we require to make adjustments includes what? One, finance cost. Finance cost is interest, is it? So here we have adjustments. Adjustments And we have one is adjustment with finance costs. Finance cost, which is equal to 750. We add it back. Finance cost is interest. And IS7, you can either, at IS7, you can classify finance cost paid either as an operating activity cash flow or a financing activity cash flow. In our case, we have been classifying it here. So what is the amount of finance cost paid? Finance cost paid. What is the amount of finance cost paid? And the amount paid is after we adjust with what? The accruals, is it? Any accrued amount of finance cost. So if we check our current liabilities, you find there is no what? There is no finance cost accruals, is it? There was no information about finance cost being unpaid just at the year. And that means then this 750 was prepaid during the year, is it? So that is a cash flow under financing. It's a cash flow under financing, is it? Yes, we go up, we have at the mean distribution. Those ones we don't do adjustment. The other item we have is share of associate company's profit, is it? Yes, that one, the share of associate profits, share of associate profit, that's not a cash flow. Profit is not a cash flow. So that is why we need to adjust it. Here it was added, therefore we do what? We less. That the cash flow related to associate is what? It is the dividend that may have been received from the associated company, is it? Those dividends, we classify them as investing activity cash flow. So then we go to our statement of financial position and non-current assets. That's where we find what? The investment in associate. And we can see it there. Investment in associate is accounted for using the equity method, is it? Which requires the investment to be adjusted with what? The investor's share of the associate changes in net assets. In our case, we find that in this investment in associate, the only item that changed during the year is profit. So that is the total change in net assets of this investment in associate. And the investor's share is the 200 reported in the income statement. So then the question is, did they receive any dividend from the associated company? Those dividends received from associates, we classify them as investing activity cash flows. That is dividends from associates. And that one we can calculate by taking the investment in associate balance as at the beginning of the year, or the balance as at the end of the previous year, which is given as what? 500. Plus the share of profits, that profit reported in the income statement, such that 500 plus 200, you get 700. But the investment in associates as at the year end is given there as how much? It's given as 650. So the reduction, we take it to be dividend received from associate, unless you are given that it is due to impairment of that investment. So dividend from associate then equals how much? It is equal to 50. That is a cash flow. That is a cash flow. That is a cash flow under investing activities. That's a cash flow under investing activities. Tuko pamoja? We still continue. There is another adjustment we require there, investment income. This is an income from investments. Yeah, if you check the balance sheet, that's another adjustment. Investment in income given is equal to what? 250. It was added in less. So the question is, what this is the investment income. The question is, was it all received during the year? If it was all received, then it becomes a cash flow. Is it? How do we know that it was received or not? We check at our current assets whether we have investment income receivable. Is it? So if you go under the current assets in the balance sheet, you find there is nothing like that. Is it? There is nothing like investment income receivable. And therefore, it means the whole amount was received. And we associate it with investment. Therefore, we have investment income received. That is 250. That's a cash flow. That is a cash flow. Then that's the end of the income statement items. We go directly to additional information. And in our additional information, we have number one, we are given an item of plant with an original cost of shillings 850 million and with a net book value of shillings 450 million was sold for shillings 320 million during the year ended that December or October 2016. One, there is a cash flow there, is it? Yeah, cash received from sale of what? The plant, is it? Yes, that's a cash flow under investing. Cash from sale of plant. And that is equal to 320. It's a cash inflow. 320. 320. 320. 320. Then this item of plant had a cost 850. It has got a net value of 450. So what is the profit or the loss on disposal? Yeah. If it had a book value of 450 and the cash received is 320, then it means what? It means that it was sold at a loss. So loss on disposal, we make the adjustment here. Loss on disposal of plant. Disposal of plant. Loss on disposal of plant. That is 320 minus 450. Is it? 320 minus 450. And you get one what? 130. That must have been charged, deducted from the profit, and therefore we add it back. Is it? We add it back. We add it back. Yes, sir. We add it back. Then we have number two. Other investments were sold during the year ended that was October 2016 for shillings 300 million. So we have sale of other investments, sale of other investments, and this was for shillings what? For shillings 300 million. That's a cash flow, is it? The sold investment. The question is, were they sold at a profit or at a loss? Were they sold at a profit or at a loss? Are they sold at a profit or loss? Yeah, you compare the carrying amount of those other investments. You can see at the end of previous year 2015, it was 250. So that was the book value, and it was sold for shillings what? 300, which means that they made a profit on sale, is it? So we have to adjust our profit. Profit on sale of investment. Profit on sale of investments, and that profit is equal to what? The 300 minus the book value 250, which you get how much? 50. That 50 must have been added. Therefore, we do what? We erase. Is it? We erase that. We erase. Number three, we are given. During the year ended 31st October 2016, Carico Limited acquired 80% of the ordinary share capital of Ashanti Limited. The assets of Ashanti Limited as at the date of acquisition were as follows. There we are given the net assets as at acquisition of this Ashanti Limited, showing all those assets and liabilities as you can see them. As you can see them. Then we are given the following information related to property, plant, and equipment. It relates to PPE. And you can see most of the information or most of the adjustments in that is about what? It is all about property, plant, and equipment. It's all about property, plant, and equipment. Such that if we can make an adjustment to that, property, plant, and equipment, which information are we not provided with? So if we make that adjustment, for example, we have the property, plant, and equipment account. We can see it is maintained at cost. Let me put it better. Yes, it is maintained at cost. It is at cost. Property, plant, and equipment. It can either be at cost or at net book value. So whichever the case we are given, should be able to make the adjustment. So we have the PPE at cost, which means at the beginning of the year, the cost of property, plant, and equipment were equal to 59.50. And as at the year end, we have the cost 7.2 million. Yeah. Then we are required to explain that change. There is also the provision for depreciation. The account for the provision for depreciation account. Provision for depreciation account. Provision for depreciation account. It's also provided. So what could be the missing information? Provision for depreciation account. And we are given the balances in that account. We have the opening balance brought forward, given there as what? Given there as 2,900. And also we have balance carried forward, given there as that 400. And then there follows a lot of information. We have a lot of information about this property, plant, and equipment, all the way from number one. In number one, we were given that an item of plant was disposed, is it? Its cost was equal to what? In additional information number one. Its cost was equal to shillings 850, is it? Yeah. That means that reduced the property, plant, and equipment in this group. Then this item had a book value of 450, which means the accumulated depreciation was equal to what? It was equal to the cost less net book value, is it? 400, is it? So that affects the depreciation. 400 for the disposed item. Then other information about this property, plant, and equipment is information about the newly acquired assets. No, the newly acquired subsidiary. And we have that information in note number 4. After those balances, we are given the cost of property, plant, and equipment of Ashanti Limited on the date of acquisition was shillings 1,000 million. So through acquisition of Ashanti, the property, plant, and equipment of the group increased due to consolidating Ashanti. Their cost was equal to 1,000. And the accumulated depreciation on the property, plant, and equipment was 400 million. So that means also the provision for depreciation increased because of that, which were equal to 400. And that is what is giving us the net book value of 600. Yeah, 1,000 minus 400. That is the 600 property, plant, and equipment given in note number 3. You can see there PPE 600. 600. Then if we continue, we are given during the year ended that 1st October 2016, there was a revaluation gain of shillings 100. A revaluation gain we debit here 100. Attributable to the holding company, property, plant, and equipment. And at that point, there is no other information about property, plant, and equipment. When we balance, we find that this side is much higher, 850. So the balancing figure is on this other side, is it? So that balancing figure equals what? This is 750, is it? That balancing figure is equal to 1,000. 1,000. So that 1,000, we can explain it to be what? That is during the year there was increase in PPE. PPE can only increase as a result of one, acquisition of additional PPE or revaluation, acquisition of a subsidiary, like that, such that we can attribute this 1,000 to what? Acquisition of additional property, plant, and equipment for cash. And that is a cash flow under investing activities. Then there is this depreciation. This side is higher, that's 800, and this side is at 300. So the difference is equal to what? Is it 500? Which we can attribute to what? Depreciation. Is it? Yeah, the increase in depreciation due to depreciation expense provided during the year, which then we use to adjust our what? Our profit before taxation. We use it to adjust our profit before taxation. We use it to adjust our profit before taxation, which we can adjust now. So adjustment for depreciation here. Depreciation expense, which we have as 500, we add it back. And also we have purchase of PPE. That is a cash flow under investing activities. Purchase of property, plant, and equipment. And that is equal to 1,000. That is an outflow. So we put it in a bracket like that. We are still continuing. We go to our number 5. We read additional information, number 5. Read additional information, number 5. And we are given there that the total purchase consideration of Ashanti Limited was shillings 450 million, paid through issue of shillings 100 million worth of ordinary shares at par value. The balance was paid in cash. So the balance is how much? It is 350, is it? So that is a cash flow, is it? A cash flow under investing activities. We show it net of any cash acquired in this subsidiary. We show it net of any cash acquired in this subsidiary. So was there cash in this subsidiary? So acquisition of Ashanti. Acquisition of Ashanti Limited. And the amount paid is equal to what? It's 450. The amount paid in cash is 350 minus net of the cash paid. Net of the cash paid. Net of what? Net of the cash paid. So 350 minus the cash that was there is equal to what? We have an overdraft, is it? In this company, there is no cash in hand, but an overdraft of what? 100, is it? So we minus that 100. Cash paid net of cash acquired, and that cash acquired equals what? Is the 100. Therefore, the net cash outflow is 400 and what? 50. It is an outflow. Cash paid to acquire a subsidiary. That is that. Then after that, we continue. You are given there during the year they issued what? During the year, they issued shares. They issued shares. That somebody is asking from that information provided whether would we just deduct that 400 minus 2900 to get depreciation for the year. Yeah, that is getting 500 through that is just coincidental, is it? Yes, it is just coincidental. It means you will not even, if this was 300, will you give, will it give you 500? It can't, is it? Yeah, somebody is arguing, you just take the difference between that 400 and 2900. It is only coincidental because depreciation of Ashanti is what? Is 400. What if it is something else? So that is person who want to bypass the entry. But that one, we cannot question it, is it? Do what you want. Yes, if you bypass that, you get it very low. Yes, in another question. Because you can see there are other transactions other than what? Opening and closing balances. Is it? You cannot do away with those ones. You have to consider all the transactions. And also, before we did this, You cannot tell somebody to just be taking this minus that, is it? You'll get it very wrong. It's only that the accumulated depreciation of the disposed item and that of the acquired subsidiary are equal, is it? If they are different, you can't get it, is it? So that is why you must adjust, because you never know. Then what else? So we still continue. I think we have recorded all what we have computed. Have we recorded? Yes, we have recorded. No, what I was saying is in number 5, there is a mention of issue of shares. That means to acquire this Ashanti, the consideration was partly paid in cash and partly paid through issue of shares. So then the question is, during the year, did they issue shares? What is that? Did they issue additional shares other than those that were issued to acquire the subsidiary? And that one we can explain very clearly there by looking at the ordinary share capital, is it? You check the ordinary share capital together with the share premium. You check the ordinary share capital together with the share premium. You find that the share capital is increasing by 500, and the share premium is increasing by 100, is it? The shares issued to acquire the subsidiary were issued at par, is it? That is the information provided, which means that then during the year they must have issued additional shares for cash, is it? Because even the increase in par value of the shares is more than the 100 for the shares issued to acquire subsidiary, is it? So in that case then, what is the cash received from issue of shares? We don't have any other information relating to issue of shares. So what is the cash that was received from issue of shares? Yeah, the cash received together with the premium. It must be what? The increase in par value of the shares, that is from 1,500 to 2,000. That is what? 500, is it? Of the 500, 100 is through issue of shares to acquire what? The subsidiary Ashanti, is it? So that means other shares issued had a par value of 400, is it? Those shares were issued at a premium, because we can see also the share premium increasing by what? By 100. So that means the total cash received from issue of shares must be what? 500, which is a cash flow. That 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 is a cash flow. So in that case, we have that. Then from there, we can now go to, now this is the last part, is it? Whenever you are doing cash flow, you can see the procedure I followed, is it? Income statement, I've gone through the additional information, and you can see I've put as many entities as possible, is it? Now the last part is go to the balance sheet, explain the changes in those assets, liabilities, and equity, is it? Explain those that have no explanation, is it? Because those with explanations, we have already worked them out. And I think you can see the only one with explanation is PPE, is it? Yeah, PPE carries almost all the explanations. That is like number 4, you have number 1, the other number 2 is other investments, which is direct. So we go to the balance sheet. Which items have no explanation? 1, PPE. PPE we have already explained, is it? And the explanation is whatever is provided. What is that? So no further explanation. Intangible assets. This includes the goodwill. Intangible assets including goodwill. And we can see it has increased from 2,000 to 2,500. Why the increase? One, it is as a result of the goodwill that allows on acquisition of Ashanti, is it? Yes. Goodwill that allows on acquisition of Ashanti, in case any. So compute the goodwill on acquisition of Ashanti, goodwill on acquisition of Ashanti, goodwill on acquisition of Ashanti. You can compute that. Because there we are given the purchase consideration is 450, is it? And it acquired 80% of the shareholding in Ashanti. So that means it acquired 80% of the net assets, is it? Net assets in Ashanti. So in that case, goodwill on acquisition of Ashanti, goodwill on acquisition of Ashanti will be equal to what? It will be equal to the cost of investment, 450, minus net assets acquired, 80% of 500. And you get a goodwill of 50. Yes. That goodwill of 50 must have increased the goodwill in this group, is it? Because must have increased the goodwill in this group. But that increase, as we can see from the balances provided, the increase of 500 cannot fully be explained by the goodwill, is it? There is still an additional increase, is it? Which means what? Which means during the year, they acquired additional intangible assets. Because the increase can only be as a result of either acquisition or revaluation, is it? When we check our revaluation reserve, the only increase is 100, which is what we were given in additional information, number 4. Therefore, intangible assets were not revalued during the year. And we can only say that they acquired additional intangible assets. That is a cash flow under investing activities. So include it in our investing activity cash flows. Include it in the investing activity cash flows. And that is acquisition of additional acquisition. Acquisition of intangible assets. Acquisition of intangible assets, which equals what? This equals the intangible assets balance as at the beginning, that is 2,000, plus the goodwill on acquisition of the new subsidiary, minus the amount as at the year 2,500. That gives us what? An increase by 450, which is an outflow. So during the year, they acquired intangible assets equal to 450 million. Then, which one? Okay. We continue. The other item we require to explain, investment in associates. Associate, we said they are accounted for using the equity method, and we already adjusted that to determine the dividend received from associated companies. Other investments were disposed, is it? And we included the loss on disposal, no, the profit on disposal, as well as the cash flow from sale of those investments. Then we have the current assets. These are working capital items, is it? So we explain the changes in working capital items. The changes in the working capital items, and those changes, we include them here. Working capital changes. Working capital changes. Working capital changes. Working capital changes. And we have inventory. We determine whether the inventories increased or decreased. Did the inventories increase or did the inventories decrease or increase? We compare the beginning and ending inventories. We compare the beginning and ending inventories. We compare the beginning and ending inventories. We can see at the beginning the inventories balance was equal to 1020. This one we increase with the inventories in the newly acquired subsidiary as given in number 3 because the group inventories increased as a result of consolidating the new subsidiary. And that comes to 1420. That is what we compare with the inventories as at the year end, 1500. And we can see that inventories did what? They increased, is it? Inventories increased by how much? 8, we deduct that. We go to the other item. The other item is trade receivables. Trade receivables. Did they increase or decrease? Trade receivables. Did they increase or decrease? Again, we do the same. Start with the opening balance, that 150. That 150. We add the receivables in the newly acquired subsidiary, 300, and whatever you get, compare with the receivables as at the year end, that's 900. So this comes to that 450, is it? So we can say our receivables also did what? Increased. That increase equals how much? 450. Yes. And then we jump to the trade payables in case any under the current liabilities. Still part of our working capital. So did the trade payables increase or decrease? We identify that also. Trade payables. And the opening balance is 1990. It's 1990. We add the payables in the newly acquired subsidiary. And the payables in the newly acquired subsidiary is equals what? 400. This is what we compare with the payables as at the year end, 22 what? 2270. And we can conclude there that the trade payables decreased, is it? Yes. Trade payables decreased, and the decrease equals what? This plus this minus this, you get what? Huh? For 120. We raise, is it? That. Such that now at that point, whatever we do is to determine the tax that was paid, is it? which we still classify as an operating activity cash flow. We still classify it as an operating activity cash flow. And to determine that, we require the taxes payable. We require taxes payable, and we can see in our balance sheet, we only have current tax, is it? There are no deferred tax, is it? There are no deferred tax balances. So we simply use the current tax. We have the tax payable at the beginning of the year, given us what? Given us 1100. We add the tax expense for the year as provided in the, as provided where? But also, yes, as provided in the income statement, which is equal to what? 1400. Also, you note that in the newly acquired subsidiary, we have current tax acquired, is it? That still increases what? Our current tax. That's 50 in the newly acquired subsidiary. So then we can say for the group, the total tax payable is this. Is the sum of this plus this plus this. Was it all paid? No. Why? Because we have current tax payable at the end of the year, amounting to what? 1200, is it? So if we can raise the amount that wasn't paid, then it is possible to get the amount that was paid, which equals what? This plus this plus this minus this, you get 1350, which is an outflow. And by doing that, it is possible then to get the net cash flows. The net cash flows from operating activities. Net cash flows from operating activities. That. So we still continue explaining our balances of assets and liabilities in our balance sheet. Under the current assets, we go now to short-term investments. Cash balance there is given. And these are our cash and the cash equivalents, is it? These are our cash and the cash equivalents. And they are the balances we are trying to explain together with the bank overdraft, is it? So before we determine what is our cash and the cash equivalent balance, let us go down there to other items. Go down there to other items. Under the capital and reserve, we have already explained the changes in our ordinary share capital, share premium, and the revaluation reserve. So the only unexplained item is the retained earnings. That one we use it to explain, we use it to determine whether the group paid dividends to its shareholders. The group paid dividends to its shareholders. You can see there is no explanation about dividends. So the question is, did they pay dividends? Dividends are usually paid out of the profits. So then the question is, did the profits change during the year? Did the profits change? If it changed, is it due to dividends that were paid? Is it due to dividends that were paid? And in that case, we can determine dividends paid. We usually classify them here. Said you can either classify them under operating activity cash flows or financing. In our case here, we classify them here. Dividends paid to who? One, parent shareholders or the equity holders of the parent. Parent shareholders. That one we can get by adjusting that retained profit, because that retained profit is the group retained profit. It is the group retained profit. It is the group retained profit, which we can try to explain the change. We can see at the beginning of the year, we have retained profit equal to what? 1,200, is it? That retained profit increases due to what? The profit attributable to equity holders of the parent, given in the income statement as 1,650. So that means the retained profit increases to 2,850. But as at the year end, the retained profit balance is given as 1,740, which means the profit reduced, is it? Yeah. Which means the profit reduced. We can attribute the reduction to dividends paid, because whenever dividends are paid, they are paid out of profits. Whenever dividends are paid, they are paid out of profits, which equals what? What is the reduction? 2,850 minus 1,740. You get what? 11, 10. So that is an outflow. Then dividends paid to non-controlling interest. We can get that by adjusting our non-controlling interest account. So we have what? Dividends paid to non-controlling interest, equal to what? Dividends paid to NCR, we adjust our NCR. We are given non-controlling interest balance as at the beginning, 300, is it? It is increased by what? 1, it is increased by the NCI in the newly acquired subsidiary, Ashanti Limited. And in this Ashanti Limited, the parent acquired 80% of the net assets, is it? Therefore, the NCI takes the 20% of the net assets as at the date of acquisition, which were equal to 500. That is 100, is it? Then the NCI is also increased by what? The profit share to the non-controlling interest, 150. So what is the expected NCI balance as at the year? It is 300 plus 100 plus 150, which is equal to 550. But the balance given in our balance sheet is only equal to what? 500. So that means the NCI reduces by what? By 50. And therefore we can say that is the amount of dividend that were paid to non-controlling interest. We go to liabilities. We have non-current liabilities. We have non-current liabilities. We have loan notes. The loan notes. These are borrowings. So the question is, did the company or the group borrow loans during the year? And that one we can determine, is it? If it's borrowed or repaid, we classify it under finance. So we have here loans. We can adjust. At the beginning, the loan balance was what? Only 500. In the newly acquired subsidiary, we can see loan notes amounting to what? 250. So that increases the loans in the group. That's not a cash flow. That comes to 750. As at the year end, the loan note balance is equal to 1,700, which means they must have borrowed additional loans, isn't it? That's why the group loans have gone up. Then we conclude loans were borrowed. And how much is the increase? 950, which is an inflow. It is an inflow we had. That too. Then from there, we have current liabilities. We have already explained the trade payables, current tax. The only item is bank overdraft, which is part of our cash and the cash equivalent. So what is our cash? And the cash equivalents at the beginning and also at the end of the period. We need to do what? We need to combine what we define as the cash and the cash equivalents, is it? And whatever we define as cash and the cash equivalent includes what? Cash in hand. Cash in hand. At the beginning, we are given, no, at the end it's given us 20, and at the beginning it's given us 10. That is cash in hand, cash at the bank, cash at the bank. For the cash at the bank, we don't have, is it? Or do we have? There isn't. Then there is bank overdraft. All this is what we refer to as cash. Bank overdraft, we have beginning balance, ending balance is 850. We denote it by a bracket, is it? And the opening balance is 980, is it? That way. So that is what we mean by cash. Then we also include cash equivalents. And our cash equivalents, we are given the short-term investments, is it? And the current assets. Short-term investments. The ending balance is given as 500, while the opening balance is 0. Therefore, what is our beginning and ending cash and the cash equivalent? What is our beginning and ending cash and the cash equivalent? This must be what? 970 negative, is it? And this one, 20 minus 850 plus 500. You get what? Negative? Read that negative. So we can say our cash and the cash equivalents have increased from negative 970 to negative 330, an increase by how much? 600 and what? 40. That is then what is our net change in cash and the cash equivalent, is it? Yes. That is what our cash flow should try to explain. Should try to explain that, such that what, let us now confirm whether it is explained. What is our net cash flow? Net cash flow from financing. Yeah, that is what we use to adjust our cash payment to acquire a shanty net of cash acquired. So get those net cash flows. Net cash flows are the financing, are the investing, and also are the operating activities. Get them fast. Get them fast, so that get the one at the operating. Get at the operating, at the investing, and also from financing. So you can even start from here. Give me from here. Now the 200 down that way up to here and down. Answer up at 200 plus 750 minus 200 minus 250 plus 130 minus 50 plus 500. You get what? You get 49, 50, 80, 49, 80, minus 80, minus 450, minus 120. What do you get here? Hmm? 49, 80 minus this, minus this, minus this. 40, 43, 30, then minus 1350, 29, 80, 30. Then we go to down here. We start again. 50 plus 250 plus 320 plus 300 minus 1,000 minus 450 minus 450. Get what? Get minus 980. That is that. Then we go to cash flows from financing activities. We go to cash flows from financing activities. Again, make those adjustments. Yeah, minus 750 plus 500 minus 1110 minus 50 plus 950. You get what? Huh? Huh? Minus 460. So then after that, you add the three of them. Huh? Correct? This is 48. 48. Huh? This is this one. This one is correct. Don't steal. So this 48 minus this minus this minus this, you get that 430. That 430 minus 1350, you get 2080. Then we now take the three of them. 2080 minus 980 minus 460. You get what we call net change in cash and the cash equivalent equal to what? If you add the three of them, you get what? Add. Have you added? 2080 minus 980 minus 460. You get 640 positive, is it? Which means it is explaining our change, is it? So that means we can comfortably now add beginning cash at the cash equivalent, beginning cash at the cash equivalent, which we have computed down here, equal to 970 negative, and we arrive at our adding cash and the cash equivalent. That is equal to 3, that negative. So that is the add. That is the add, and it is well explaining. It is well explaining. At least it reminds you of the whole thing, is it? It reminds you of the whole thing. It reminds you of the whole thing. The way we used to explain the statement of cash flows. The statement of cash flows. So if you check the cash flows from operating activities, we have adjusted the profit to arrive at the cash flow. That is what we call the indirect method. So then, can you now try to use the what? To use the direct method and come up with the cash flows from operating activities. Try to use that. That is requirement part B, because the examiner may specify. The difference is on how to arrive at what? This cash flow from operating activities. The investing and the financing remains the same, is it? Those ones have no method, but the way we arrive at this figure may be arrived at using this way, the indirect method or the direct method. So go to direct method, try to explain that. We have a short break. Then we come back. Now we go to the other method, that is direct method. We try to come up with the workings that we need so that we get the cash flows from cash received from customers, cash paid to suppliers, as well as the cash paid for the operating expenses. So we can explain that one here. That is direct method. We get those three items. One, calculate cash received from customers. That one you calculate by doing what? Reconstructing the receivables account. You reconstruct the receivables account. Yeah, the receivables account. You can see in our balance sheet we have the account receivable, the debtors. Debtors are our customers, receivables. So that we determine how much cash was received from these customers. So we have from the balance sheet, the opening balance of our trade receivables, given that 150. We also have the closing balance, the closing balance given that 900. During the year, there was acquisition of a subsidiary called Ashanti Limited, and that Ashanti Limited receivables increased the group receivables by 300. And also during the year, we have sales. Sales, we take that all sales were on credit. Those revenues given in the income statement. Given as 25. 25 what? 5 that. So if we do all that, what is the cash that was received from those customers? That is the balancing figure in that. That's the balancing figure in that. So this plus this plus this, you get a total of what here? 28. Huh? 28, 980 minus that 900, you get cash received to be equal to what? 25? Huh? 0.8. Then number 2, calculate purchases. Calculate purchases, which that we take, they were all on credit. And this one we can comfortably calculate by reconstructing the inventory account. The inventory account, which has got an opening balance equal to what? Opening balance of our inventory from the balance sheet is 1020. Yes. Just a minute. Yeah, that is we compute purchases. We can see our inventory balance as at the beginning, and also the inventory balance as at the end, is it? Which is equal to 1500. Now, during the year, they acquired who? They acquired this Ashanti, and there were inventories amounting to what? 400. We debit here, 400. That increased the group inventory. Then, during the year, they purchased inventory, is it? But we are not given the purchases. What we are given is the cost of inventory sold. That is what we call cost of sales, is it? Yes. The cost of sales is given in the income statement as what? 18 what? 140. But this cost of sales, we were given in additional information number 6 that it included depreciation and also loss on disposal of plant. So the depreciation of 500 and the loss on zero of plant 130 were included in this cost of sale. So if we remove the depreciation and also the loss on disposal of plant 130, we will be left with the cost of goods that were sold, is it? That were purchased and sold, which is equal to what? 17? What? 510. Such that if we can balance this account, the missing information is purchased, is it? So this balance, you get what? 18, 19, 010 minus 1020 minus 400, you get purchases equal to what? 17, 590. Then working number 3. Working number 3, calculate cash paid to the suppliers of goods by reconstructing cash paid to suppliers of goods. by reconstructing the payables account, the trade payables. We reconstruct the trade payables account, and we can see it at the current liabilities, trade payables. Trade payables, and we are already provided with the opening balance. The opening balance is equal to 1990, and the balance as at the year end is provided there as what? 2270, is it? Yes. Already we have computed our purchases, is it? From the inventories account, which is 17,590. What is that? And also during the year, they acquired Ashanti. Ashanti increases our payables. And the payables in Ashanti equals what? 400, is it? That such that we have what? This plus this plus this, you get what? So that we get the cash paid as the balancing figure. 19,980 minus 2270 minus 2270, you get the cash paid to suppliers of goods equal to what? 19,980 minus 2270, you get 17. And finally, calculate the cash paid for the operating expenses. Those distribution and administration costs. They are also operating expenditures. So what is the cash paid for those ones? Number 4, cash paid for operating expenses. Yeah, our operating expenses, we get them from the statement of comprehensive income. We have distribution cost. That's an operating expense. Distribution costs. Given how much? 1250. And also we have admin expenses. Admin expenses. Admin expenses given 2640. Finance costs are not operating. So now these are the operating expenses. The question you ask yourself is, were they all paid in cash? Or did they include non-cash items? Did they include non-cash items? What is that? Did they include non-cash items? And we have those items that we used to adjust our profit. We have those items that we used to adjust our profit in our cash flow from operating activities under the indirect method. We ask ourselves, items like finance cost, that one you can directly identify it in our statement of comprehensive income, is it? Therefore, you can say it wasn't classified as part of either distribution or admin. Share of associate profit is also done what? It's also separately disclosed, is it? So it is not part of distribution or admin. Investment income the same. It is separately disclosed. Loss on disposal of plant we are given was classified as what? Cost of sales, is it? Profit on sale of investment. Where I see it? Can you see it? The question was silent where it was classified, is it? depreciation was classified as what? Cost of sales. So we adjusted our cost of sales. Therefore, the only item that must have been included in that classification, either as distribution or admin, is what? Is this one, is it? Yes, is this profit on sale of investment. So it is part of those two items. We adjust it so that, because that is not a cash flow, is it? Profit on sale of investment is not a what? It's not a cash flow. So we must adjust this by adding that profit on sale of investment to get the actual cash that was paid. Profit on sale of investment, which is equal to what? 50. We are adding why? Because when they combined it, it reduced the expenses. Because it is offsetting profit and what? And expenditures. So we add it back to get the actual amount of cash that was paid, which is equal to what? This plus this equals 30, 39.40. And that is all. Now we can present our cash flows from operating activities. CARICO group. Statement of cash flows. Statement of cash flows for year ended. For year ended when? That is 31st of October 2016. And there we have cash flows from operating activities in millions. So we start with operating cash flows. And using now the direct method, we take cash from customers, is it? And the cash received from customers is what we got here, 25,080. Then cash paid to suppliers, cash to suppliers. And the cash paid to suppliers we have here 17,710, is it? That is an outflow. And the cash paid for the operating expenses. Cash paid for operating expenses. And that is 39,40. If you less all that, what do you get? What do you get? Huh? That for that. You can see it here, is it? It is this one. Then tax paid is the same, 1350. And we get net cash flows from operations. Which is equal to 20,080. I've used a very simplified way of calculating cash flows from operating activities using the direct method. And that is the end. That's the end of the class. We meet next time, God willing. We meet next time, God willing. That is the end. That is the end. So bye.